While we were finishing the first audit, the silver crash story escalated, from market panic to talk of resource wars and global realignment. And here's the risk. Misunderstand the structure underneath, and you follow the wrong story. The Hidden Economy posted a YouTube video on February 1st called Silver Fraud Exposed. They claim silver's crash from $121 to $75 last Friday was engineered by banks and insiders, but the numbers don't support that claim. First, he says last Friday, JP Morgan closed 147 short contracts at the exact low and precisely harvested leveraged liquidations. But silver's daily volume that day was over 317,000 contracts. 147 contracts represent roughly 0.04%. A 39% crash almost inevitably triggers tens of thousands of forced liquidations across leveraged accounts. Selling one bag of flour doesn't earn you the profit of the entire grocery store. Moreover, delivery reports often show brokerage accounts, not ultimate position holders. That account could belong to JP Morgan's proprietary desk, or it could just be one client. Without knowing the final ownership structure, any motive inference is speculation. Second claim, he claims silver fell 39% while the mining ETF only fell 22%, proving smart money didn't sell silver. But mining stocks are corporate assets, not commodity inventory and not futures positions. When you buy mining stocks, you're holding mines, equipment, cash flows, and extraction capacity. You're not holding silver bars in a warehouse. The fact that institutions didn't sell mines only proves they still hold the companies. It doesn't prove they're still holding the underlying commodity, the silver itself. Mining companies can still profit even if silver doesn't rise. They earn production margins, not price bets. So mining stock stability only means the businesses can still make money. It doesn't mean capital is betting on rising silver prices. A company valuation is not a silver bet. Third, he says CME raised margins to keep suppressing silver prices. That's not what margin is for. Margin exists to stop the system from breaking. If you use $10,000 to control a $200,000 position and the price crashes, you don't just lose your $10,000. You owe money you don't have. The clearinghouse has to front the money first. Then the system goes hunting for who ultimately owes it. Raising margins is how the system stops fronting reckless leverage. When volatility spikes, the exchange raises margins. It's a fire break, not a weapon. And this isn't aimed at longs. Shorts are hit too. Even profitable shorts can be forced to post new margin when requirements rise. Daily profits don't guarantee you meet the new threshold. If your account can't satisfy the new margin level, you're forced out. So after margin hikes, price might keep falling, it might bounce, or it might swing violently. Because what's happening isn't suppression, it's simultaneous deleveraging of both sides. Let's step back and draw the system map. There are three different arenas in this story. The futures market, where short-term leverage explodes. The stock market, where companies are valued on long expectations. The clearing layer, the infrastructure that keeps the system alive. These arenas don't move for the same reasons. But he collapses all three into one story, so every difference turns into conspiracy. So what actually caused silver's price volatility? First, people start believing silver will rise. Maybe it's inflation, currency concerns, industrial demand, geopolitical risk. The reasons vary, but what matters is consensus forms around upside. The market's first step isn't price, it's belief. Institutions and silver ETFs start buying physical or futures. Real capital enters the market. Prices start rising. The rise is healthy, but rising prices attract leveraged capital into futures markets. The faster it rises, the more people chase. The more people chase, the faster it rises. Futures prices form a self-reinforcing loop. Physical follows passively. This is the critical turning point. Leverage starts dominating the market. Price begins reflecting position crowding, not physical supply and demand. When the rise is too fast, sellers won't post cheap sell orders. If buyers want to execute, they must accept higher prices. This is called a liquidity vacuum. Price jumps aren't conspiracy. They're what happens when nobody wants to take the other side. The bubble forms here. When too many people are betting with borrowed money, the market gets structurally fragile. Price ticks back just a little. Someone hits their margin limit. Their account runs out of cash. The system automatically sells their position. That first sale pushes the price lower. Lower price triggers the next account, then the next. The liquidation chain begins. The trigger can be anything: a speech, an appointment, even a tweet. But the trigger doesn't decide the crash. What decides the crash is this: the market was already piled with leverage. Futures often crash first. Stock markets tend to react with a lag. At this point, some people want to buy the dip. Others want safety, so they rush to physical dealers. Inventory drops rapidly. Dealers raise premiums to protect remaining stock. So you get a strange situation. Screen prices falling while shop prices rise. This is physical premium expansion. Leverage amplifies both directions. The crash was leverage clearing. This isn't a script, it's structure. So how do you judge whether the next silver crash is real supply demand or leverage liquidation? Watch 3 signals. Signal 1. Are futures and physical moving in sync? If it's real supply-demand change, both markets usually move together. If it's leverage clearing, futures crash first and physical reacts with delay. Signal 2. Is the physical premium expanding? If screen prices fall while physical premiums rise, it often points to stress in the retail distribution chain and forced futures liquidation rather than a global disappearance of silver. Signal 3. Did the exchange suddenly raise margins? If margins are rapidly increased, it usually means leverage was stretched and the system is actively cooling down. If rules haven't moved, the move is more likely coming from underlying supply-demand forces. These signals won't tell you what happens next. They tell you what's happening now. Structure, not story. Audit 1 ends here. But the system is still moving. New claims are forming around physical markets, Shanghai premiums, and institutional migration. Audit 2 will begin where paper ends and physical reality starts. Thanks for watching. This is the Fiscal Ledger, decoding the systems we still live under. The modern world wasn't born in a moment. It was engineered over centuries by capital, law, and design. From medieval credit to modern markets, Europe and North America wrote the operating code of power, and we're still running on it.